For this video, we are going to use a blank plan, which means all information will need to be entered as we develop the plan. The purpose of this sample plan is to assist people who have personal debts and want to repay them so they can commence building their wealth once the debt is repaid. Before we start, there are two things to discuss. The first is loans with penalties for early repayment of loans. Check that there are no penalties. These are often associated with fixed interest loans. Unfortunately, there's not much you can do about that unless you want to pay that penalty. The second is to consider which loans should be repaid first. In general, loans with the highest interest rate should be repaid first, followed by loans where the interest rate is not tax deductible, such as home loans. In this plan, there are 3 loans and these are their interest rates. To commence the plan, select New Blank Plan. This will be a 10-year savings plan for a single person. On the objectives page, we can write the objectives, followed by the strategy and general comments. The transaction account has a balance of $10,000 which is being kept for cash reserves and will not be used to repay loans. John's salary is $120,000 for the first 5 years, followed by $150,000 for the next 5 years. We are not going to allocate how much of the salary needs to be saved to repay that home loan, as money needs to be used to repay the credit card and personal loan first. These loans are paid through the budget. The credit card has a balance of $3,000. The credit card limit is $5,000. Note that you can have 2 entries for credit card fees to accommodate a lower fee in the first 12 months with new cards. For this exercise, there is no introductory interest rate and the purchaser's rate has been reduced from the default rate of 15% to 12%. On the payment schedule, there are multiple options. On the selection combination, you have a minimum payment amount, so that if the payment option you have selected does not meet that amount, then the minimum payment will be selected. This is to help those using a percentage of balance. In addition to a percentage of fund, you can also add dollar values over different time periods. For this exercise, we are going to use the option fixed amount. John wants to repay this $3,000 over the next 12 months. It is a matter of trial and error to find the value, which in this case is $275. John has a personal loan of $20,000 which is to be repaid over 4 years. The default interest rate is used and there are no loan costs. John would like to reduce the time taken to repay this loan from 4 years to 3 years. Again, by trial and error, he determines he needs to make additional payments of $140 a month. The cost of these repayments is made in the budget, and here we can see when the loans will be repaid. We must now set up our home and home loan. With the home loan, you have 4 types of loans. With the principal and interest loan, you have 2 options. The second includes an introductory interest rate, a redraw facility, and a refinancing facility. This option has been selected so we can consider how these options may be used at the end of the video. The interest rate is the default rate and there is no period of fixed interest. There are no loan costs. The loan is to be repaid over 20 years, but John wants to repay the loan in 10 years. Let's look at the investment plan. Here we have yet to allocate any savings from salary. The amount of the home loan payment is listed, but you need to know what that value is as a percentage of salary. This information can be found in the 5-year loan report. Here we find the percentage of salary for each of the first 5 years. From that information, we are going to allocate 15% of salary to savings for the first 3 years and then increase the percentage to 20% after all the personal loans have been repaid. Now we can go back to the home loan and make a schedule of loan repayments which John can afford using the extra 5% of salary. Sometimes it is a matter of trial and error to find how much you can afford each month. So here's the schedule which has been prepared. As you can see, there are significant savings in interest costs and the length of the loan is reduced by just over 10 years. Let's look at the budget. The budget is where you can look at your expenses and see where savings could be made. In the PDF, all the living expenses have been listed, and they are also in the sample plan in the software. In the budget, you can list some items which are optional. It is important to list the items which are optional. Later in the plan, we will look at how you may use some of that optional expenditure to repay debt. On the reports chevron, there are two reports which calculate the same information, but the debt management report includes tips of debt reduction and the 5-year summary report does not. I want to discuss this report as some information will help you understand debt management. The first section is about your debt servicing ratio. This is the percentage of after-tax salary used for loan repayments. There are two sets of calculations. The first looks at the rate, where you include the optional additional payments, and the second without the additional payments. The interest rate risk assessment is especially important, particularly in times of low interest rates. The software defaults to review the effect of an interest rate rise of 2% on all variable interest rate loans. You can change that percentage if you want. The program calculates the extra repayments that will be required if the interest rates rise. The report then takes into consideration any planned additional payments. In this case, no additional payments for the first 3 years are planned, and means that you would have to find that additional cost. In the last 2 years, you have already allocated some additional payments, and these additional payments will cover the cost of increased interest rates. We have had low interest rates on loans for some years now, but look at what the average interest rates have been in the past, usually around 7%. Could you repay your home mortgage if interest rates return to the long-term average? The next section is about reducing debt by using a percentage of optional budget expenses. If you nominate a percentage of optional expenses you are prepared to forego to reduce debt, then the software will calculate the approximate savings in interest. There are several other sections giving detailed information on your loans. Before we complete this video, I want to discuss using some of the features in the principal and interest loan with options. Many people use an offset account to store their additional payments. The idea is that your interest on loan cost is reduced by the interest earned on the savings held in the offset account. The important issue is that you can access these funds. There may be tax implications, and you need to have a conversation with either your financial advisor or mortgage broker regarding these implications. The software does not lend itself to having a formal offset account for several reasons. However, the redraw facility can act as a proxy. By selecting the data view, the value of the additional payments, and thus the amount which you would have in your offset account, is displayed. You can withdraw those values in any year. Finally, there may be times when you plan to refinance in the future. You may want to do a home renovation and plan to borrow more money using the equity in your home. Let us have a quick look. You click on the tab Refinancing and tick the box. Here we plan to refinance in 5 years, borrowing an extra $20,000. Now you have a second loan where you will need to complete the details. Note the graph shows where you borrowed the extra funds. If that money was used for a renovation, you should go back to the home account and add the cost of the building improvements together with the anticipated increased value in the property. That concludes our discussion of debt reduction. Now you could expand the length of the loan to say 30 years and consider how you could purchase an investment property in year 11. You can also use modelling tools to consider the effect of rising interest rates. To conclude, I would like to say there are two types of debt: good debt and bad debt. Bad debt is consumer debt which does not grow your wealth. If you want to increase your personal wealth, saving for your personal lifestyle expenses is something to consider. Your Financial Mappers account allows you to set financial lifestyle goals and save for those personal expenses such as cars, boats, holidays as a separate account. Good debt is debt which can be used to increase your wealth by using other people's money. Examples of good debt would be to borrow to buy either a home or an investment property. However, for debt to remain good debt instead of bad debt, you need to apply some sensible rules to your loans. Things to consider are: what if interest rates rise? Could I reduce interest costs by keeping the length of the loan as short as possible? Do I have income protection insurance in case I can't work? Do I have life insurance so if I die my family can afford to pay down the debt and stay in their home or keep that investment property to produce income? For more details about the Sample Debt Reduction Plan, you should read the PDF in the section Sample Plans.